This is our third video in our series on the federal budget. We started out with the federal budget process, took a look at what we spend money on, and now it's time to take a look at how we actually get the money in order to be able to pay for all that. So we'll be taking a look at what type of federal taxes we have and also the tax policies that we have as well. And there are a number of decisions that we'll see that the federal government makes that can have a great impact on how much people pay on taxes and a bunch of different incentives that they provide for people to behave in certain ways and to consume certain products or do certain things. So we'll be taking a look at the overall tax policy of the United States and see how that works. So if we just take a look at taxes within the federal system, there'll be a couple of highlights from here and there on state and local taxes, just to give you an idea of how they compare to the federal taxes, but this is mostly on federal taxation. Each level of government, or each government in the United States, has traditionally had its own primary source of money. There are concurrent powers between the federal and the state government to tax. Local governments can only tax what state governments give them the ability to be able to tax. It's a little different relationship. But in general, at least since the passage of the 16th Amendment in the early 1900s, the largest source of revenue for the federal government has been the personal income tax. As we take a look at state government, historically it's been the sales tax. In other words, the amount of money that you pay on a product when you buy it. For example, in Pennsylvania, the sales tax is 6%. Most products are taxed on that except for food products and basic necessities. Now, many states have instituted income taxes, and in many states, the income tax is on par to the sales tax. Although we'll see a little later, the sales tax is still the highest overall source, but the income tax is also important. And finally, at the local government level, historically, the property tax has been the biggest source of revenue, and it still is. However, we can differentiate a bit between school districts, which are a big source of expenditures at local levels, which rely almost entirely on the property tax, versus your local municipalities, who rely on the property tax as well, but also have, in many cases, earned income taxes as well. So these are the three kind of basic taxes that fund the different types of government in the United States. But just be cognizant that the changes have been coming, and personal income taxes really are a source of income for all three levels of government. So this is a really cool website that there's a link to up in the right-hand corner. It's the U.S. Department of Treasury's Data Lab, and they provide the sources of revenue for the federal government. And if you look here, what we see is that the individual income tax, as mentioned, is the largest source of income for the federal government at about 50% of all the money that it brings in. Second of all is a category that we generally call the payroll taxes. And these are Social Security and the Medicare taxes, which account for 34% of all income. And then finally, one of the smaller sources of taxes that we have is corporate income taxes. These have steadily gone down as a source of income for the federal government. Basically, the government makes the argument that the higher the corporate income taxes are, the less competitive we are as a nation. Now, that's about 7%. And then we have a couple of these last couple of categories, which if you look at the bottom part, there's a little arrow, and breaking that out, excise taxes count for about 3%. I'll take a look at that in a second and so what that means. The ever-present miscellaneous, about 2%. Customs duties, which are essentially those fees laid on products coming in from other countries, about 2%. And then finally, people pay into the unemployment insurance system here in the United States. That's about 1%. And then estate and gift taxes. So, for example, you're limited in the amount of money that you can give to individuals in your family and outside your family, and above that, you have to pay taxes on it. There are limits on the amount that you can pass through to people when you die as well without a tax. And then there's some other retirement things. But let's break that down a little bit more and take a look at some alternatives here, which are the state government general revenue. Unlike the federal government, which relies solely pretty much on the income tax and our payroll taxes, in other words, taxing individuals, we see that state governments receive about 1/3 of their budget from intergovernmental transfers, meaning coming from the federal government. And 23% of their taxes come from the sales tax, and then the income taxes we saw here as well. Excuse me. Local government gets about 1/3 of its revenue from intergovernmental transfers. In this instance, they come either from the federal government or the state government, or from the federal government through the state government to local governments. And we see that the property tax is the biggest source of revenues here. Just going back up here, you'll click through here. Excise taxes are essentially taxes on products that we buy. So one of the biggest taxes that we have, the sources of income, would be on the federal level is on gasoline. So I believe it's about 18 cents a gallon. And that goes to the Highway Trust Fund. So there are all these types of jet fuel taxes and all this kind of stuff that's taxed on products that we buy, and those are excise taxes. In some respects, it's a bit like the sales tax at the local and state level. All right, so here's the question that we ask ourselves. We know there is a lot of income inequality in the United States, and we take a look at that in a different unit. But one of the things that we do have in the United States is a progressive tax system, whereby those people at the top rungs do pay the overwhelming amount of money coming in from federal taxes. So this is the division of who pays taxes by quintiles or by 20% increments in the United States. So if we take a look the whole way to the right, it says all federal tax. What we see is that the bottom 20% of Americans only pay 0.7% of all federal taxes, whereby the top 20% pay 68%, right? So let's just take a look at that 3 quintiles, 0.7%, 3.5%, 9.4%. So as we examine that, what we see is that about 13% of all taxes are paid by the bottom 60% in the United States. And then about 30%, or about 31, 32% overall, are paid by the bottom 80%. So really, an enormous amount of money is paid by the top 20%. If you go down to the bottom category, what you'll also see is it broken out by other increments. And you'll see here that the top 1% in the United States pays 20%, 26.7% of all taxes, and the top 0.1% pays 13.8%, right? So the top 1/10 of 1% of earners in the United States pay the same amount as the bottom 60% do in this country, right? Now, let's just take a look at a couple of qualifiers here. If you take a look at the individual income tax, you'll see that the bottom 40% does not pay any tax, and it's around 43%, in which case they pay zero income tax or get money back from the federal government in the program that we'll talk about in a couple of minutes. So as far as the income tax is concerned, the top earners in this country pay most of the income tax. And if you drill down, so the top 20% pay 86.9% of all the income tax. but the top 1% pays 42.1% of all income tax in the United States. Now, what is a more regressive side of the tax system is really the payroll tax, which has to deal with Social Security and Medicare. And as we've seen before, that comes out of everybody's paycheck at an equal amount of money. So there's not a graduated or progressive income scale there. So you do see that with that, the lower rungs of income earners are paying more as a percentage of the payroll tax in the United States than are the rest of the country. And also you see that the top 20% is really not contributing as much as they do when it comes to overall taxes or income taxes. And the top 1% only contributes about 5.4% of all the payroll taxes. Again, because there are limits on the amount of your taxation. I believe it's about $137,000, whereby you don't get taxed above that. At least that is the case with Social Security, not the case with Medicare. So what about the tax system? I mentioned that there's a progressive and regressive tax system. We have a progressive tax system in the United States, which means that the more that you earn, the more that you pay your income. So there are three general categories that we have: single, married, filed jointly, and head of household. Just put up the various brackets that we have here in our current federal tax system for both unmarried individuals and married individuals. So if you have income below $9,700 and you're an individual, you don't have to pay any taxes on that money. If you are a married person filing a joint return, you can make up to $19,400 without paying income. And then what you see is progressively, the more income that you make, the more that you'll be paying in taxes. So we have rates of 10, 12, 22, 24, 32, 35, and 37%. And the way that works is in a somewhat complicated formula. Each segment of your income gets taxed differently. So, for example, the 10% rate is for anything up to $9,700. That would continue to be added on. But then take a look at $9,700, you move from 12% up to 22%. So anything from $9,700 to $39,474 will be taxed at 12%, and then the increments as you go forward. Now, what makes the system even complicated, even more complicated above that, is the fact that when we examine the way taxes are run, everybody gets a personal exemption, which means if you're single, you don't have to pay taxes on the first $12,200 of your income. If you're married filing jointly, you don't have to pay taxes on the first $24,400 of your income. And if you're the head of a household that's not considered to be a family, perhaps single parent, or taking care of an elderly person, whatever may be the case, the first $18,350 you don't have to pay any taxes on, right? So we take a look at our tax system. Now, one of the things that's interesting, as we flipped back and took a look at this, this chart, who pays taxes, and you examined the individual income tax, you saw at the bottom lowest quintile and second lowest quintile, it was minus 2.5% and minus 1.6%. You ask yourself, well, how is it that they pay? How is it can you have a negative payment of income taxes? Well, we have in the United States a program that is actually very popular with both Republicans and Democrats, and is also being used at the state levels as well, some states. And that's what's called the Earned Income Tax Credit. And essentially what this does is it's an incentive for people to be able to earn money, an incentive to be able to help the working poor in the United States by not only giving them back any federal taxes that they would be paying, but also just giving them a lump sum check in the tune of a number of dollars to help them get by. So basically, the federal government is subsidizing them through the tax system. So you can see here the chart of how much you might get. So you can get a maximum credit of $529 if you have no children. You know, 1 children, 2 children, 3 children, you get additional credits, which would come back to you. So let's just say that you're, married couple that's got 2 children. You could make up to $5,828 a year in this earned income tax credit. Kind of phases out as you go through. So, the reason why this is a popular program is, if you take a look at the chart in the lower right-hand corner, is that it has a pretty powerful effect on anti-poverty programs in the United States here. So 28.1 million people are eligible or have used the earned income tax credit and child tax credit together in 2018. And it's lifted 10 million people out of poverty, as well as making 17.5 million people less poor. And it's also benefited millions of children in the United States. So these are programs that prove popular. Democrats like them because they help the poor. Republicans like them because they don't really create a bureaucracy. They just give money back to people that are working. So for Republicans, it's a non-bureaucratic way that also encourages people to work. And that's why these programs are quite popular. Now, here's the problem. Oftentimes, I ask around in classes, and if I said, how many people, what's the cost to go to the university or Widener? How much is the cost to come here? And somebody might know that figure. And I'll say, but everybody in this room is probably paying a different rate to come here, even though the official sticker price is X, right? We all pay different ones because we get certain scholarships and loans and all kinds of stuff. Well, it's the same way when we take a look at the tax code as well. So there are a number of common deductions that people use when making their tax returns and determining how much money that they can pay. I just want to preface this by saying that in 2017, we had tax reform, which is probably the signature program under President Trump. And that tax reform changed the standard deductions. So if you see the married filing jointly, that's up to $24,400. In many cases, what that means is people don't reach the threshold of being able to use a lot of these common tax deductions. But nonetheless, they're still here. So, the federal government's tried to encourage people to own their own homes. And one of the ways that they do that is by allowing you to write off the interest on your mortgage. That's been changed. It used to be whatever your home was worth. Now you can only write off the interest on your mortgage of the first $750,000 of your mortgage. There's something called a home equity loan. So say, for example, you paid into your house for a while and you need a loan to be able to go out and, say, add a new roof. You can borrow the home equity loan. That interest used to be completely deductible. Now it's only deductible under the Trump tax reforms if you're making improvements to your house. If you borrow money against your house because you want to send your kids to college, you can't deduct that. And the other thing is, we do have a lot of other stuff in life in which, we pay interest on, like credit cards and car loans, and none of that is deductible, but mortgage interest is. The other thing I should mention that's on here as well is student loan interest is deductible as well for people. One of the things that's very big is charitable contribution deductions. So if you make a contribution to Widener University, which I would encourage everybody to do, that money is then, you don't have to pay any tax on that money. Same way if you have a religious institution that you belong to, or if you give to the Red Cross, or whatever nonprofit charity that you might give to, that's the common tax deduction as well. Since the advent of the 16th Amendment and the income tax in the United States in the early 20th century, you've also been able to write off your taxes that you've paid to state and local government. For most of us, that would be income taxes, wage taxes, and property taxes that we might pay on the houses that we own. This was changed substantially in 2017 with the Trump tax reforms. Now you can only deduct up to $10,000. And the reasoning behind that was essentially political. There's two reasons. A, it really isn't a very good subsidy because it favors the wealthy in great amounts, as we'll see in a couple of minutes. But second of all, Republicans were very cognizant of the fact that highest tax states in the country are generally Democratic states. So the federal government was subsidizing the Democratic states at the expense of the lower taxed red states, Republican states. So they really stuck it to the Democrats on that, and took most of that away. Every year when I do my taxes, I get child credit for having children. It's one of the few times of the year when they actually don't cost money. So if you have children, you get a tax deduction for them up to a certain number of children, after which it actually decreases. And childcare expenses in some situations are able to be used as a tax deduction. And then finally, if you work out of your home and your home is your sole source of office, you're allowed to deduct home office expenses for that. And that's a tricky one that gets flagged very often. So for example, let's just say right now, I teach at Widener, and during the summer, I mostly work from home. But because I have an actual office to go to at Widener University, I can't write off my home office. As long as you got somewhere to go, you can't have an office to write off. Now, all of these things that are tax deductions are what we would consider to also be tax expenditures, or ways in which the government attempts to be able to encourage certain things. And I'm not going to go through all of these, but these are the largest tax expenditures. In other words, things that we don't tax in the US that could be taxed. One of the biggest things is, and this goes back to the 1940s during World War II, when we started our system of private health insurance, wages were frozen. And as a consequence of that, one way that companies gave more money to people was by providing them with health insurance. And so we've developed a system of health insurance in the United States whereby the businesses that you work for, in some cases, for most of us, pay for our health insurance. Now, that is paid for on top of your salary. You don't get taxed on that. And that could be worth $10,000 a year or more. So that's money that the government doesn't tax. And in 2019, that accounted for $172 billion. So it's not a small chunk of change. We also have, if we talk about investments from stocks and buying and selling stocks as well as other properties, we reduce the rates on capital gains. So you don't pay the same amount as you would if it were taxed as normal income. That cost $127 billion. Credit for children and other dependents is $121 billion. Tax benefits for employer-defined contribution plans. A lot of us, get money for our retirement plan through things like a 401k plan or a 403b if you work for a nonprofit, whereby your employer will set money aside for you X number of dollars per year to go into your retirement. And then also defined benefit plans are essentially pensions where basically your employer says when you retire, we will be giving you X number of dollars a month or a year. So those are some really big sources of tax expenditures. You also see the earned income tax credit there, which I mentioned was very popular at $72.6 billion a year. Now, I'm sorry about this. I've tried to find an updated source of information for this on who benefits from these selected major tax expenditures, but I haven't been able to find one. So this is a bit dated. It's about 7 years or so old, but my guess is that this hasn't changed too much. So health insurance exclusions benefit those people who are generally at the upper end of the income because you're more likely to have health benefits the more money that you make. So that benefits people at the upper end. Pensions, again, a lot of people that are in working class jobs or in service industries don't get pensions or retirement programs. So that benefits people at the upper end. Capital gains, again, not a lot of people at the bottom end of the economic spectrum have these types of assets. And just skipping down, state and local taxes, the more you make, the more you pay. So it's obvious that the deduction would be better off for people that make a lot of money. Mortgages, the mortgage interest deduction. Obviously, the more wealthy you are, the more likely you are to have a house. And the more wealthy you are, the more likely it is that your house is going to be more expensive, so you have more money to deduct. And then finally, wealthier people generally tend to make more charitable deductions, and they make use of that at a higher rate. And just to skip down to the bottom, and the only two areas where we see these tax expenditures assisting people who are poor are in the example of the earned income tax credit that we looked at earlier, which really is the only thing that out benefits the bottom 20% out of any of these things. And then the child care tax credit as well. So that's where we're at. Now, just to show you this, one of the things is we've talked about a federal budget deficit being around $1 trillion. For years, people have been trying to phase out many of these tax expenditures and get rid of all these deductions in order to streamline the tax system. If we were to get rid of all of these tax expenditures, which would increase taxes by about $1.5 trillion a year, that would shore up the entire governmental system. But it would not be very popular, right? Because it would raise income taxes on quite a few people. And a lot of those people would be middle-class people that get health benefits and so forth. The other problem is, there are lobbyists in Washington who have their individual tax expenditures, maybe that don't show up necessarily on that list that I just saw. Every time we have tax reform, lobbyists are working very hard to make sure that their tax expenditures are stuck in there, and we're never quite able to streamline the system. So a lot of policy, a lot of things we don't think about. April 15th, taxes are due, but there's a lot of tinkering with how much we actually pay. And depending on your circumstances, whether you're married, whether you're single, whether you're the head of the household, whether you have children, whether you have a house, whether or not you give money to charities, and all these other types of things really make a profound difference because government tries to incentivize certain types of behavior. And that's what we really call tax policy.